we are very short on Treasury. And we are increasing our position in Treasury. Treasury right now is 4.3% on the 10-year. It's resting on a 200-day moving average. That 4 point, I'm on the record right now in May to say, before it's all said and done, the 10-year Treasury is going to double to over 8%. I would say within the next 18 to 24 months.
Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking to John Lee. I spoke to him back in October of 2022. John is the CEO and executive chairman of Silver Elephant Mining. John, welcome back to the channel. How are you?
Great to be back. Thank you for the invite.
Oh, you're welcome. So we'll get straight to it because things are really exciting in the world of precious metals and everything else for that matter. And just to let the viewers know, we're conducting this interview on the 23rd of May on a Thursday. I want to start, though, with what you said back in October 2022, and things were fairly different back then. And you told me that back in 2021, when the US 10-year yield was below 1%, that it would go to 3%, and you're right about that. But we're going to focus on gold and silver. At that time, around the end of October, silver was below 20, and gold was actually below 1,700. And you got your gold forecast right because you said you expected it to go above 2,000 in 2023, and it did. It closed the year at 2,062. I think in December, we spiked to 2,150 overnight. Silver, I mean, you were bullish and you thought silver would challenge the 30 level, and it did, and it went up to like 26. But you were only a few months, I guess, early, because as we speak here, even though we've had a bit of a correction in the last 24 hours, silver is still above 30 and has been as high as 32.50. With that, John, could you tell us a little bit about your views for the precious metals going forward, and maybe even for the bond market and the US 10-year yield?
I'm glad at least some of my predictions or some of the content that I provided aged well. I made a right call on gold, and earlier in January of 2024, I in fact went on a couple of other podcasts and stated in my Twitter, people can look me at John Lee, Silver Elephant Twitter. I said it is the best time to buy gold because it's about to break out of that $2,100 all-time record. And the target I had for gold, I said by March, was about 2,400. So we reached that level. Now my call on silver is a laggard, and it is the performance field. Silver had disappointed somewhat at the get-go of the year and throughout all of last year. And it's always hard to contribute reasons, but you never know the reasons. Nobody knows the reason. You can be making the right call, but your reasoning could be flawed, and nobody knows about it because the market is a collective conscious of a few billion people. My speculation is that silver's underperformance has got to do with apocalypse development in China. What's happened in China in the last 6 months is akin to what happened in the financial crisis, 2009 financial crisis in the United States, where not just the ordinary credit union local banks went under, but the top 3 or top 5 real estate developers renegated not just a couple of $1 billion, hundreds of billions of dollars of debt, and you have a wholesale basically a collapse of the real estate market in China that has suppressed lots of industrial activity. So across the board, you have base metals that were underperforming. And secondly, silver is also a key physical silver investment demand in China is also a key driver for the silver price going forward. And if you are struggling to eat, and if your houses are going under for close, there is not appetite, especially for retail investors. And that is really the main that is really sort of what silver markets cater to, not central banks, are just not. This is a very tepid demand, and also that silver is, well, you can say, Mario, but then what about gold, right? Gold is also China is also a big investor in gold. Well, silver, China is a big export of silver. So if you look at during that period from first part of 2023 to first part of 2024, everything that China exports were going down. So I think overall, just the lack of industrial demand, just the tepid growth in economic growth. You look at the oil price, which is also correlated to silver. So that industrial elements of silver was suppressing the silver price. Not to mention that, of course, the markets always manage, just make the facilitator or the invisible hands to manage the silver prices a lot easier. Going forward, I am a lot more bullish in silver than in gold going forward. The few reasons, if you look at the gold to silver ratio that we talked about, it has been going through a 10-year plus consolidation on the high end of the gold to silver ratio between, I will say, probably, the top of the funnel and the bottom of the funnel is around 100 to 70, and that's been sort of wedging. And now the ratio is broken down below 80, trading at around 75. It is a very significant breakdown of the ratio. So what that means is that, and given the ratio was toppy over 100 last year, that the ratio is likely to continue trending down below 70. It could go down as low as 30. I wouldn't, probably 50 is probably a number that would be a reasonable estimate. So even at a 50 gold to silver ratio at, say, current $2,400 gold, and then you'd be looking at close to $50 silver, and which probably is my call, as I just broken out at the $30 handle last couple of weeks or 10 days ago. So my target for silver, we're encountering a bit of seasonality coming into people say selling May and go away. So we're in a bit of weakened seasonality. The dollar index is resting on a very strong 200-day moving support, about 104, and it's going to make a run to past 106 to potentially 110. So these are the two negative factors driving gold and silver right now. And the positive aspects are just we can talk about the sort of the dollar hegemony, the geopolitics, the diversification from central banks are the principal drivers. And then the technically gold is broken out at 2,000. At 2,400 is going to take a bit of a break technically, and the silver is broken out at 30. There's not a whole lot of resistance to 50. So technically it's very bullish, but timing and sort of seasonality is kind of entering a bit of a weakness coupled with the rising dollar. I don't have the crystal ball call. I thought it's going to go to 35 like within the next 30 days, but you had a big reversal of copper and a big reversal of silver. It could be a garden variety, try to instill volatilities to shake the market participants out. I would be, however, very surprised to see silver go below 30, because 30 is such a critical handle resistance. We've been talking about it for a long time. And every time silver breaks out of 30, it goes to 50. There was maybe 2 or 3 occasions silver broke out of 30. So I think the next 10 days is critical. If silver sustained over 30, it's going to make a run at 50. If not, then we could be looking at some summer doldrum until September, which is typically strong season for the next rally for gold and silver.
Where do you see, I know it's difficult to forecast, there are some people talking about $3,000 gold by the end of the year. Are you that bullish, or do you think we might stay around 2,400?
Not unreasonable target. We're entering into absolutely uncharted territory, and typically you have such a strong emphatic breakout at 2,000. 2,400, which is only 20% over the breakout level, is tame. If you look at the breakout of gold of $30 in 1970s, it went to 800. If you look at the breakout of gold at $250 in year 2020, year 2000, when Gordon Brown sold the last batch of gold, gold went to 500 in that fairly rapid run. So if you look at technically the cup and handle formation, so the neck is the $2,000 level. So the bottom, the trough of that cup and handle, the bottom of the cup is is around 1600 or 1500-ish in the last since 2010. So from linear scale, right? If you then just flip it on the other side, 2400 was my target, and that's why I came to that target. But if you're to measure on a log scale, then the target becomes around 2800. And then gold and silver has this knack about when they go up, they go up. We talked about it, right? Metals investor, especially, is spend 8 years with penny suffering, and when they go up, they tend to run up big time in a very short period of time. And we can discuss why that is. It's philosophical, it's management, and all that. So I wouldn't say a very definitive call, but the chance of gold going over, getting to 2800 this year, I think is higher than gold staying at 2400. And the least likely scenario is for gold to re-challenge $2,000 level. Highly unlikely, but still possible. And then technically speaking, though, I mean, I think the 50-day moving average for gold is 2300, and the 200-day moving average for gold is around 2050. The 200-day moving average, 50-day moving for silver is 27 or 28, and then for 200, which is a greater support level, is around 23, 24. So the chart looks quite stretched. Certainly, we're past the first or second inning, like we were talking about 6 months ago. However, that shouldn't deter you to continue to hold a core position. On the trading, it's always been very difficult to trade because you're fighting against the tide, and the markets are heavily managed, and constantly try to stage these breaking down, try to reach those technical levels. So it's not an easy position to trade. I would say if silver went back to 30, which is what we are today, and I didn't think it would go back to 30. So I think for the people that have time horizon longer than a couple of years, good discouraging spending, it is on a grander scale, good time to get in both fundamentally and technically.
How do you see the, and I've spoken about this, I follow a few, one guy from Hong Kong and a Chinese silver analyst, and they follow the Shanghai futures and gold exchange. And we've seen for the last 6 months, or even back in December last year, the premium in Shanghai was quite big compared to the London and New York price. And it seems like, China, the China exchanges are kind of setting the price, and maybe the paper market on COMEX and LBMA is losing influence. Do you see that?
I am not an expert in the commodity markets. I don't study a whole lot of how silver is trading in India versus China, and their volume and their physical trade versus their paper trade. China does have a 25% tariff to the United States for anything that it imports, and some of them are a lot higher. And it's not an easy exercise to do that arbitrage. So I am not an expert in sort of in analyzing how those gap in prices actually, which one is tail, which one is the head, right? Who's wagging the head of the train or the bottom of the train. With that though, the COMEX silver price is very heavily managed. It's never a good indicator of the physical demand. If so, then oil price would never have gone negative in the financial crisis. And so with pretty much all the trades, not even in the commodity sector, if you look at the COMEX or the futures market, and it's well documented that the paper volume, the nominal value of the paper changing hands are anything from 50 to 100x of the underlying metals that changing hands. So, I mean, I think silver, you're looking at something like 100 million ounces, like the volume of COMEX in 2 week period surpasses all the physical trades of silver. So I don't think the paper market is a good indicator of what is to come. And what's more interesting is if you want to talk about the disconnect between the potential disconnect between the physical and the paper market, we'll be looking at the premium of numismatics of the United States. The premium of that over the physical, over the futures price. I think that would be a good indicator. I haven't tracked the margin, but I think the margin or the gap is widening. Like I think that I'm not sure what a ounce of silver eagle is, but I wouldn't be surprised it's in the $45-50 range already. with silver trading it is. Because when we talked about silver under 20 ounce of silver eagle was trading at in the 30s. So I mean, these levels of gaps are quite unprecedented. I think it's going to go higher because the deliberate throttle of the by the government and by the power that be to discourage the physical discourage the physical buying. I think short answer, I don't think it's a good indicator of just because some other market is trading higher. But I yet to see any anecdotal empirical evidence to back up that thesis.
Great. So let's move to the geopolitical side and the BRICS. We spoke about that back in 2022, and it looks like not conflict, but the saber rattling between the West and the BRICS, or China and Russia, is getting much more pronounced. And how do you see that affecting not just gold and silver, but commodities in general? It seems to me that in terms of globalization, we're creating two blocks now. It's almost like West versus East. How do you see that?
Mario, I appreciate going on your show because I'm given the potential topics like 10 hours at a time. So it's almost like I feel like I'm going back to my school days trying to defend my thesis or my degree. And all these topics I used to be a very prolific writer. I've written hundreds, maybe 1,000 plus articles before I started running Silver Elephant. So these are very good topics for discussion. I am literally coming up with answers with this from the seat of my pants. I would say the breakdown of the hegemony is deliberate, and it is the power that be. They're just a bit tired of. They got nothing better to do, to be honest. From what I see, they just that's just create a bit of excitement, and then create a bit of excitement, and they don't like the growing influences of different nations that's eroding their power. They don't like the rise of middle class and having greater say in what they can do, cannot do, and where they can go and what they can buy, cannot buy. So they're coming up with this WF and all nothing and be happy. The BRICS is part of the result of part of that. So certain factions in this world globally are renegating on this hegemony where there's less benefits to be staying than opting out. And then looking at what happened to Russia with over $300 billion confiscated and then cut off the Swiss system. Again, it's deliberate by design because the Russians refuse to play the opium war game in ceding controls of their oil, in their land, in their physical, in their assets. And the same invisible hands are making similar demands around the world for them to pay their due. It's almost like the annual, like a UN, right? Annual dues. But the dues are behind the scenes in critical assets, infrastructures, in strategic sectors, in high tech, in pharmaceuticals, et cetera, or also in access to their domestic markets to create greater influence in these different parts of the world. The creation of the BRICS and the greater influence of the BRICS are the principal driver for gold and silver, as I mentioned to you before, and it's to do with the diversification from the dollar system. There's been a lot of talks of the BRICS currency 6 months ago, started earlier last year, and I came on the show and said, I don't see that as a possibility because they don't even see, it is not like the EU, okay, where it's a sort of big family coming from the same origin behind the scenes. You're looking at these people are differently culturally, like from the start of the civilization, and so they're not going to see like how are they going to I just don't see who's going to control the printing press, of what ratio are the currencies and debt levels going to be allocated from the debt to GDP ratio, from all just different aspects of it. And the Indians don't trust the Russians as much as the Russians trust the Brazilians or collectively to the United States. So you don't see Indians or Brazilian go to Russia to diversify their real estate portfolio. They still come to the United States, and it's a bit of a silly proposition to see that currency come to fruition, in my view. However, that doesn't stop them from sort of coming up with a plan B, right, as an alternative option to conduct commerce, because right now majority still rests on the dollar, and when you go to Turkey and certain part of Eastern Europe, they are resting on the euro, which hasn't done very well. A lot of inflation and exceeding their control, like a lot of inflation, and the euro hasn't done well relative to the dollar or nor to the gold. So these countries adopting euro hasn't done very well either. So I think these BRICS countries are buying gold and silver, storing gold and silver, and literally you can Google every country: Brazil gold, India gold, Korea gold, Russia gold, right? They are going through out of the window, the demand. So I see this division in the world just going to create greater fuel and demand for gold and silver, along with the 100, 200 billionaires that are buying gold and silver just to get out of this digital currency system. Same with commodities. The fractional world is just going to create more friction of doing business. Like, for example, if you were to fly from Vancouver to say Vancouver to Hong Kong, for example, you used to be able to fly through Russia airspace, right, through near Antarctica, but now you have to follow the routine to, let's say, if you go to Tokyo, Alaska, through to Tokyo. So just the travel time extended by 20% for many of the routes around the world. That's just my pure observation. You add the tariffs, you add the inspection, you add the invisible tariff, meaning just the deliberately slow down of the commerce transactions, shipment in commerce and wiring of money across the globe. It's just got a lot more friction in doing business. And then you also have this ESG, it's called, we talked about that too, environmental sustainability, social responsibilities. And what that spells out down to is you can only source locally. A lot of the government subsidies, regulations will prohibit you from purchasing parts from outside of the origin of countries of which they're not permitted. So add it all together, the cost of doing business is going up, the cost of manufacturing is going up. It's going to drive up further inflation and prices going forward. And what we have is a destruction of demand and the disruption of supply. And I just see that continue to go, where the supply is coming tumbling, but the demand is also coming down across the globe from where I see. And the result of it, and then you have inflation, the unit of currency is fluctuating. So you're just going to have this pattern of a lot of volatility in price actions, but overall the trend is going up.
Yeah, and just wanted to talk about a topic that a lot of people debate on, and that's whether we're going to see, especially with the Dow around 40,000, the NASDAQ, like, I don't know, it's around 18,000 or something. I think the last time we spoke, it was up around 11. And gold as well, 2,400 high, it was 2,450. Do you think we're going to see like a melt-up style environment where the currency drops and people want, things and hard assets and even some stocks? Or is there a danger of a deflationary collapse?
The deflation discussion used to dominate 50% of the press back in 2010. You have the Ian Gordon's from Canaccord talking about the Kendrick winter, and then you do the 5 sort of like, like 1, 2, 3, 4, and the K or something like that. Low talks about all this K-drop winter, well dumbfounded. Back then, that was about 8,000 to 10,000 around 2004 to 2010. And they said the Dow is going to go to like 1,000, like 100, right? And I'm just looking at the world. I'm like, holy, like, I don't see the food running out, supermarket running out of food. I don't see empty buildings, and I just see more developments around the world. The question is philosophical to some extent, Mario. You got to understand the philosophical. You got to understand the underlying system, and which is what Henry Ford said. If you understand how this monetary system works today, you'll be going on revolution tomorrow, and that was over 100 years ago. You got to understand who owns the printing press, and the Fed, which is, as I looked up literally 2 minutes before the call, the Fed is owned by the Board of Governors located in Washington, D.C. And the governing body of the Federal Reserve System is appointed. It reports to the Congress and is nominated by the President of the United States. Now, who is the president of the United States? And, which means who are the governor? Who are these governors? And if I were to go to the bank and borrow $1 million for my mortgage, I will submit the application, somebody will review and approve it. Arm's length. You're looking at my balance sheet, looking at my income. And just think for a minute, right? Like, who is really controlling the Fed in lending, say, $1 trillion? And what you are looking at right now, the equity market, is somebody is buying hundreds of billions of dollars of equities on a daily basis. You have BlackRock, you have, they say, that's just an ETF diversification. Well, okay, who is coming out with the trillions of dollars giving it to BlackRock and Vanguard and State Street? Today, these ETFs and other offshore accounts are owning collectively probably venture to say 70 to 85% of S&P 500 already. So what is, and obviously the rise of interest rate and tightening of monetary policies or the lack of dividends with the risk-free rate double hasn't deterred them from continuing to purchase these assets. So what is to stop them from continuing to bid up these asset prices? You also have the likes of Warren Buffett and Jeff Bezos are reportedly the largest farm holders and land holders of the United States. So Mario, if they are buying equities, they're buying gold and silver, and they're not buying gold and silver, but if they're buying equities and gold and silver doesn't matter, but if they're buying equities and if they're buying lands at 5% interest rate, what should stop them from doing the same at 10% interest rates? So you got to just understand the unit measurement is different, and the dollar is fiat. The dollar is fiat. It is a voucher system for the peasants. It's, imagine you're running a castle and you're the king of the castle. You're printing these vouchers for the people that are working, and majority of, I just talked about in Canada, 70% of your income goes to housing, 30% to the food. I mean, that's the definition of a slave. So that's a voucher system. There is not going to be collapse of debt. The banks are just a facilitator of the distribution of the system. Now, even if all the banks collapse in the world, the asset owned by the banks are just fiat currencies. It's just the printing press. If you have a broken printing press, you just buy, manufacture another printing press, which is just digital, print some more currencies. Like, if JP Morgan go down tomorrow, like, your homes is not going to crumble. It's not cause an earthquake. Everything's still there. It's fiat. You could have an engineered correction in the equity market, just like what happened in the financial crisis, in the pandemic, in the dot-com bubble, because interest rate continue up. The reason they will do that is just to cool down gold and silver, to cool down the equity market, to create the pretense that there is a potential correction, potential deflation. And the reason for that is to deter, Mario, is to deter the average ordinary people from buying. And that is the advent of the cryptocurrencies, is to not make people buy equities because they want to buy equities. And why do they want to buy equities? Just to conclude 30 seconds of this topic. Imagine you're the king of the castle. What do you want to own? You say, okay, I want to own, and you have 5 billion people that report to you. Just hypothetically speaking for a minute. Well, you don't want to confiscate all of the real estate because you want to get them a place to live, right? So you can do that through taxation, just to nibble away their income. You want to give them an illusion that they have their own freedom. You don't want to impose their curfew, but you can create the digital currency so that after a certain time, you cannot go out party anymore, and you cannot eat so much. They can control what you want to eat. And they control where you want to go. If the king want to go to a vacation in Venice, they don't want to be crowded with all those people. So, and then what else do you want to own as a king, right? You want to own the newspaper because you want to control what people say about you. You want to own the military. And you also want to own technology that you can surveil what people are doing or saying. And you want to control the educational system. You want to control the supply chain infrastructure. And that's why you're seeing they're buying Apple and Microsoft despite lackluster earnings. And that's exactly what they're doing. They're buying equities, and they're buying all key controlling power towers in order to continue to manifest their agenda, which is greater influence, and then keep the not even keep the status quo, but to continue to exert greater influence and control over the general public. So I don't see Dow ever have a huge correction. Nasdaq is broken at all-time high, and your pundits are still talking about, oh, the correction is just around the corner, right? For anybody who has got a rudimentary degree in technical analysis can tell you it's a raging bull market. Doesn't matter who's buying or selling. Somebody's fueling the fire, and the fire is going to continue higher, because that's so that the king is able to continue execute their agenda.
Interesting that you pointed out that cryptocurrencies are for the peasants, so to speak. So they think that they own something, but the king and his courtiers, they want to own real assets and like technology and the land, most of the land. So yeah, I never thought of it like that. Maybe we could talk a little bit about silver elephant mining, and then switch over to gold and silver mining shares, and why do you think they've underperformed the bullion, and what might wake them up? So maybe you can tell the viewers a little bit about your company.
Yeah, let's talk about the mining companies in general. The gold is the XAU, and I don't track the XAU over gold or HUI over gold ratios anymore, because this has been abysmal in the last 30 years. The question was given to me, like I said, 10 hours, so I had like 30 seconds to think of the answers. Really, they're twofold in my view. First of all, the mining companies are heavily managed, just like the price of gold and silver, just like the currency, like the bonds. We can talk about the yields as well. Right now, we're having inverted yield. That doesn't make any sense whatsoever. And I think the yield is going to revert back to the 10-year, yielding higher than the 2-year, not because of the lowering of the interest rate by the Fed, but rather the public coming to the recognition and realization, epiphany, that the rates, high rates, are here to stay. So you're going to have a big reversal of the interest rates, long-term interest rates going a lot higher. And the interest rate in the 2 years not going to go lower. That's the backdrop. And then secondly, on the mining company side, the mining shares are very heavily managed. I know, because we run silver elephant mining. And I would say on an ordinary day, 70 to 80% of our volume is algo driven. And on a lot of days, you will see the first Majestic is really the symbolic trade. It's really sort of the representative of the silver mining sector. You will see a lot of times first Majestic exhibiting weakness, even though silver on a good day, and the next day silver market get whacked. So the first reason is the market is very heavily managed. There's a lot of naked shorts out there. It's well documented. People are shorting the market without having the prerequisite or the requirement to deliver for extended period of time, up to weeks and months, even years. And we can talk about the system, which is broken. And then the other reason, Mari, is there is a disconnect between the gold and silver buyer versus the equity mining investors. And mining companies really a derivative. You got to look at it as a derivative to the gold and silver price, because the valuation is art and science. It's a combination of current earnings, future earnings, and also optionality, meaning the amount of metals in the ground. So you're really buying in essence options call on gold and silver, and the decay, Mario, the decay on gold and on the mining company. I'm sure you understand that terminology, is the depleting reserve. Because as gold and silver mining company keep mining, their reserve go down, so their optionality dwindles. Just like the time factor for option diminish as time goes on. And then the other one is just the operating expenses, right? We have to feed ourselves, and depending on the size of the company, the operating expenses can also eat away your equity. And then you have all the geopolitical risk and all the different elements in mining. So it's a very, very complex industry. So overall, I believe mining company now is a great buy, because the ratio of the mining company divided by the metal prices are at a historical low level. Doesn't mean it can go lower. It cannot go lower. It doesn't mean it can be hovering around this level. What it's going to take for the mining company to I mean, certainly the prices, gold and silver prices hasn't reflected to the cost of doing business. And what is going to drive the the mining prices higher is the answer is the metal prices got to go high enough for producers to deliver cash flow. That's really that simple an answer. And from there on, the producers, the Barrick and the Barricks and the Newmonts and the Barricks and Newmonts and the Bellwethers, the Imanas and First Majestics has got to deliver a dividend. And from there, that gain can then be funneled through or rippled down to the juniors and then to the to explorers and through that ecosystem. And the yeah, like I said, the physical buyer, and I mean, if you look at back in 2000, it's very much the same. So what also that tells you is the people that are buying gold and silver, by and large, are not the common share of the guys are buying mining equities. So that's telling you it's the gold and silver market prices are not driven by retail, especially not by the American retail. You see what I mean? It is the billionaires, right? They're buying. So that disconnect is going to be. It's either the mining company shareholders are wrong, or the metals are. I think in the end it's going to be resolved with much higher metal prices. That's gonna drive the profitability of mining companies, and then eventually majority. I know because I look at my share register. Majority of our shareholders are United States, Canada, certain parts of Europe. So as a very very small subset of investors, and that then it might take a little while, but right now we're back to the year 2000. Where there's more money, more opportunities available to the number of money that's available. And it's just a 30 seconds plug for Silver Elephant. I mean, we got 100 million ounces of silver in the ground. The project had over $50 million investment. It is producing silver today. So we are revenue and we've been sustaining ourselves for the last year with very minimal dilution. We've only diluted 2% of our equities in the last 12 months. And then we're trading less than $20 million market cap. It's a fraction of the replacement value. We're selling silver for less than 20 cents an ounce in the ground. So, what's the catch? As I mentioned, there's just not enough money available to invest in the opportunities that are being presented. And I will be a little careful I'll be a little careful because as I said, even though there seems a lot of liquidities available if you look at the equity markets, you look at the real housing market, but that money is it's a different. It's the king that owns it, right? It's not the peasants. But there's a void in the peasants. They don't have money, and we know that we know that. So still very selective set of investors with discretionary capital that's being deployed in the mining sector. I don't see that number change very quickly in the short term. So they still have opportunities. Investors doesn't need to necessarily chase per se, and then you just gotta pick the right company with good resources in the ground. Hopefully that's producing, but not at a great loss, and good balance sheet, and has a good balance sheet near producing status that's near permit status or project is fully permitted, and that has a good resource in the ground. So that you'll be able to, you cannot just rely on this money ounces in the ground, because the risk-free rate today, Mario, is 5%. A big subset of investors used to speculate in the market. It gone. Either they retire, kick the bucket, or they say, you know what, I'm 60. I can get 5% yield right from the bank. I don't need to be chasing the speculative investments that used to be yield me zero, like during those zero interest rate environments. So landscape has changed a lot, and opportunity exists today, though. And I think it's a pretty good entry point for miners if you believe of higher metal prices to come. But at these current metal prices, the mining companies are not making money, and that's why they are not for the dividend cash flow type of investors. They are not good investment. The people you want to get in now are people who believe much higher metal prices to come and buying these companies as optionality and as potential cash flow in the future.
Yeah, interesting. So you just see that higher prices will eventually tip the balance and people will get involved.
Yes.
Yeah. So to conclude here, John, are there any kind of advice that you'd like to tell the viewers? And the other thing I would say, this is not financial advice, it's just John's opinion, but not just on finance, precious metals, but On the bombardment of fear, from the king, so that the peasants are always scared. Is that something that you consider as well?
That has been the way for a long time. But because of the outreach of the internet, right? So they dial up that notch, and they have become less deterred, like from manifesting their agenda right out in the open. Can you imagine the woke agenda or gender equality or some of these hogwash things that they try to sort of impose on the public? Like, had there not been the internet, how much more effort would they have to exert, right, to reach the same results? They conclude, and you talked about crypto as being sort of a voucher system. It's not the crypto, it's the dollar that's a voucher system. The crypto is a diversion from people from buying real assets like real estate in the equity market. My takeaway is that don't be distracted by the economists. I used to follow economists are like religiously. Every time the market, they say they drop the interest rate and the equity go up, and they say, oh yeah, the equity go up because they anticipate Fed dropping the interest rate to stimulate the economy. But then if the stock market goes anyway, they can always make up a story, right, to fit the market action. So it's like if the economic readings go if the CPI go up and then the market go, and if the CPI go anyway, my point is they will always conjure up a story to fit their agenda. The trend for equity is going up. It has been going up since 1930s, since 1970s, since 1980s, since 2000, 2020. It's going to continue to go up because the king need to own these media, these controls. Interest rates are going a lot higher. There's no and the people talk about higher inflation is manufactured to justify the higher interest rate. If you go to Japan, they purportedly have 1% inflation, their interest rate is 0.25%. Higher interest rate actually drive up the price of production because your cost of capital goes up. So higher interest rate doesn't necessitate to lower inflation. And then, like I said, the last 10 years, from 2010 to 2020, the oil price is average about $70, interest is 1%. And now oil is still $80, interest is 5%. So I wouldn't just from my point of view, interest rates go a lot higher. And that's going to drive up your cost of doing business, mortgage, and just living expenses. Be prepared for that. Deleverage. I sold 2 homes out of my dozen or so, and put that money into silver and gold and silver elephants. And I would deleverage. The prices, like I would deleverage, and I would not speculate on lower interest rate to make leveraged investments. And if there's one trade, I've been talking just the last few days. I'm also the chairman of Oracle Commodity Holding, which is my passion of making investments. We are very short on Treasury, and we are increasing our position in Treasury. Treasury right now is 4.3% on the 10-year. It's resting on a 200-day moving average. That I'm on the record right now in May to say, before it's all said and done, the 10-year Treasury is going to double to over 8%, I would say, within the next 18 to 24 months. And the reason for that is every time the yield curve is inverted, there's only 3 or 4 times in modern history since I was born in 1974. There was only 4 times the yield curve is inverted. When they're inverted, it's because there is a crisis. The Fed will tap emergency brakes, bring down the short-term interest rate to 0 or near 0. But the long-term interest rates are steadily declining since 1980, from 15% steadily going down. So then you create a temporary scenario where when during the financial crisis, the low short-term interest rates go down. You have a long-term that's very high, so that's a very widening yield curve. But then when the economic growth started, the Fed will overshoot, raising the short-term interest rate, try to cool the market. So that's such as the case in the dot-com bubble, in the 2005 post dot-com bubble, where the short-term interest rate went up a lot. 2005 post financial crisis, 2011, they jumped the interest rate short-term a lot higher, and then 2018, right before the financial crisis. So the inverted yield curve, which is the short-term interest rate greater than long-term interest rates, always come down to normal. Is because the Fed will then tap out on the brakes and start lowering interest rates short-term again. But this time around, the short-term interest there is here to stay at 5%, maybe go to 7%. But the long-term interest rate is gonna the yield curve is gonna resume to normalcy by long-term interest rate go a lot higher than the short-term interest rate. And the long-term interest rate historically is averaging about 2 to 3% of the short-term interest rate. That is the norm, which means that if the short-term interest is at 5% or 6%, could go to even 7%, then the 10-year should be yielding at between 8 to 10%. And that, Mario, for the takeaways, nobody's out there making this call, such as this call, is my call from here on for the next, I would say conservatives, just call it, the next 2 to 3 years. So you want to be shorting treasury. If you want to make a short bet on treasury, you want to sell your bonds. You want to keep your commercial papers, 2-year, 3-year commercial papers. And in the end, conclude the show. When are we going back to the peaceful era, right? When are we see the climax in all this craziness? Is when the long-term interest rate is a lot higher than the short-term interest rate. So if you look at a 7% short-term interest rate, 10% long-term interest rates, that is time when we look at the world and say, has the king exerted enough havoc across the world that the king is going to say, okay, that's enough. I'm going to take a break. So that is, returning to peaceful times.
And then the peasants can start living again and prospering a little bit, right?
And we're not there yet. Just shows you majority of the public are absolutely sleeping to be believing that the Fed is going to drop interest rates back to below 2% to accommodate the 4% long-term interest rates. Not going to happen. The 10-year right now is sitting at the 200-day moving average, very strong resistance level. You're going to see a lot higher interest rates. So my nugget of thoughts, not even advice, thoughts to share with your audience is deleverage. I am not a big fan of the real estate market. Maybe it'll go up because the king is buying, but I would deleverage. That's my number one negative advice. And secondly, buy gold and silver, not because you want to make money, but because you want to get away from the digital currency system where you've been mandated on where to buy, where to go, and when to buy. And then maybe dabble into the junior in the mining sector, just to sort of dabble on it to get through your day if you're a retiree.
Great, John. That was really great speaking with you, and hopefully you come back when 10-year yields are at 8 or 9 or 10%, or even before that.
Or gold is 2,800 and silver is 50. I think we have a greater than 50% chance this year.
Yeah.
Yes.
Yeah, great. So enjoy the rest of your day, and it was nice speaking with you.
Yes. Oh, one more thing. Silver Elephant, ELEF, OTC, SILEF, silverelephant.com. Thank you for the invite again, Mario.
You're welcome. Take care.